2013 meeting of the Santa Barbara City Council Finance Committee will now come to order. Seeing no members of the public wishing to speak on anything within the jurisdiction of this committee but not on today's agenda, we will close public comment and go to our first item. Mr. Samario.
Thank you, Mr. Chair, members of the committee. Bob Samario, Finance Director. So we're here to talk about our insurance programs, and this is not something we're required to do. We just come here once a year to the Finance Committee only to talk about our insurance programs, just to kind of edify the committee on sort of where we're spending our money, how we're covering our city from exposures. Just kind of by way of background, before I turn it over to Mark Howard, who is our risk manager, he'll be doing really most of the speaking. We have, as you can imagine, it's being a big operation, quite a few exposures. Workers getting injured on the job. We have liability claim exposures, so with trips and falls, the classic things that we see where somebody trips on a sprinkler in a city park, they sue us because of that. We're subject to natural disasters, whether it be earthquakes, floods, tsunamis, and the like. And then things like auto liability insurance, where somebody who drives city vehicles who may cause damage to others or themselves. And so those are a big exposure we have to kind of protect against. And we spend currently about $6 million a year for all of our insurance programs. So it's a lot of money that goes out every year. I wish I could tell you that we are 100% covered, but we're not. We are not nearly 100% covered in all respects, and you'll see how that works out. And primarily because in some cases it's impractical for us to insure things like streets and sidewalks. So we have to focus on what's really things that we need replacement, and there's some things we just can't cover. And Mark will go into that. And a lot of that is just a decision about how much money can we afford. We're trying to maintain some reasonable costs for these things because we don't have an unlimited amount of money, and we have to be sensitive to that. So we make decisions inherently about what are we going to cover, how much are we going to cover, and that's really something I think you should really focus on when you hear his presentation, Mark's presentation. There are some choices we've made, and we'd be interested in getting your feedback on that. So with that, I'll turn it over to Mark Howard.
Great. Mr. Howard.
Thank you, Chair. Mark Howard, City's Risk Manager. Today we're going to be talking about the insurance program. We have a brief outline here for you to follow along. And what we've got is the purpose of this presentation is to provide background and insight about the self-insurance fund, its cost drivers, and a brief overview of the exposures included and excluded from the different insurance coverages. So you'll get an overview of what we are covering and what we're not covering, as Mr. Samario pointed out. And then we're going to talk about three of the programs: workers' compensation, general liability, and the property insurance. So with that, we'll start with the workers' compensation program. You may know that workers' compensation is a state-mandated requirement for every employer. The city, like every other employer in the state, has to provide workers' compensation coverage for its employees. So the city maintains a self-insured retention, or SIR, of $750,000 per claim. That's the piece that we pay out of our operating budget, operating fund balances. The city is part of a JPA called CSAC, which is the California State Association of Counties for excess workers' compensation coverage. The members of that JPA pool losses between the self-insured retention and $1 million. Then the JPA purchases insurance above that limit for what they call statutory limits. What is a statutory limit in the workers' comp program? By California law, that means that any cost to relieve and or cure the effects of an injury must be paid for by the employer, or in this case, our JPA. So if somebody has a debilitating injury that requires multi-millions of dollars in health care payments over their lifespan, we have to provide that coverage. And through the CSAC program, we do provide that.
May I ask a question?
Of course.
Well, how often, Mr. Howard, so how often does that happen when someone needs multi-million-dollar medical attention?
Has it happened?
Let's start off with has it happened. It hasn't happened yet for the city of Santa Barbara. And how often does it happen? It's a rare occasion, but even under those rare occasions, the employer of record must provide the benefits to the injured worker. So it's not often, but it does happen. As I said before, we are currently running with a $750,000 SIR. We have no claims that have had payments to exceed that SIR, self-insured retention. To date, we have several claims that we have reported to our various excess insurance coverages because we expect claims payments to exceed our self-insured retention over the years. From years past, we are collecting monies from previous excess policies for claims that date back as far as the 1970s, where we're still providing benefits to those employees and receiving reimbursements from those excess carriers. So the city uses a loss control option as a way to minimize the frequency and extent of the injuries that are reported by city employees. We have in the Risk Management Division the Occupational Safety and Health Program, which provides many ways to minimize those exposures, including our Injury and Illness Prevention Program, which is mandated under the Cal-OSHA Act, and its requirements for training, medical screening, return to work programs. And the city does operate under a safety committee operation where we have a citywide safety committee, and each of the departments have their own departmental safety committee to deal with unique exposures in those operations. The big thing here is that we look at it using the philosophy that fewer claims equate to fewer costs going out the door. So that's our philosophy that we use. This chart shows us a 10-year look at the claim frequency in workers' compensation. These numbers are as of June 30th, 2012, so at the close of business with the fiscal year 12. And you'll see it shows a 10-year downward trend in the frequency of injuries reported by city employees. The next chart is the claim severity, or the costs paid on those claims in each of the fiscal years. Overall, it's a downward trend over the 10 years. There are two fiscal years, fiscal year 9 and 11, that had some extreme losses that are skewing those results. And those losses were identified in our last actuarial study. The city, every 2 years, hires an actuary to review our loss history and help us define what kinds of amounts of money we're going to need to operate the self-insured fund. That actuary did identify that the costs in fiscal year 9 and 11 are pushing the requirements higher than we have seen in years past. This chart shows our workers' comp claim payments for each fiscal year. This is the amount of money that the self-insured fund actually paid in each fiscal year for benefits to injured workers. Overall, it's a downward trend over the past 10 years, although you will notice in fiscal years 10, 11, and 12, it's beginning to creep back upwards.
Mark, question. Are you going to talk about what it is that caused that downward trend in claims over the 10 years?
I can answer that question.
Okay.
So the biggest cost driver to bring the cost down over the 10-year period was the drop in frequency. We went back a couple of pages. You'll see that back in fiscal year 3, we were averaging close to 200 claims a year. We are now down to a little over 120 claims a year, almost a 50-60% decrease in frequency. Also, during fiscal year 4, you may recall that the state legislature revamped the workers' compensation system and put in some cost-saving measures that were very useful in driving costs down over the last 6 or 8 years. In the last 2 or 3 years, some of those cost savings that were part of the 04 Reform Act have been removed through legislation and or court rulings. So now we're seeing those things eroded and costs starting to climb back upwards.
Okay, thank you.
You're welcome. This chart shows us how much we've been paying for excess workers' compensation premiums, for the amount that we paid, for example, in fiscal year 12 to CSAC, our excess JPA. And you'll see that it was quite high 10 years ago, and it came down dramatically in the middle years. That was the effect of a soft insurance market where insurance is cheaper to buy than in a hard insurance market. Insurance markets have been hardening over the last 2 years. That combined with the increase in claims payments that we've seen, you'll see that our excess premiums are starting to tick up again. So issues and considerations going forward. The city is insulated from the instability of the workers' compensation premium market due to its participation in CSAC with a $750,000 self-insured retention. When you buy first dollar coverage, you buy the fluctuation in the insurance market, and by having a self-insured program, we are insulated from that. We are expecting and hearing from industry analysts that insurance costs for excess workers' compensation may increase 10% or more in the coming 2 fiscal years as healthcare costs continue to rise. Healthcare is one of the larger cost drivers in the workers' compensation program, and as those healthcare costs continue to rise, we will see premiums increase. That, combined with several companies choosing no longer to do business in California, will make it a smaller pool from which we can actually purchase insurance. And with that, we'll move on to the general liability program. As Mr. Samario was telling you earlier, we have exposures to different types of losses under the general liability program, which would include trips and falls, auto claims, and the like. And under this program, the city is self-insured for the first $1 million. And then we participate in a JPA again for excess of that $1 million. The JPA is called Excel, which is the Authority for California Cities Excess Liability, just a short acronym. The pool shares losses from above $1 million for an additional $4 million. So there's 11 other cities. We're one of 12 cities in this pool. We pool those losses in that layer, sharing costs, and then above that $5 million layer, the pool purchases commercial insurance for larger losses. To date, we have not had any losses from any of the pool members that exceeded the shared limits layer. But almost every year there is one or more of the cities has a loss in that shared pool layer where we have to contribute. And the city's contribution is based upon 2 items, its payroll and its experience level. So the more employees you have, the higher your payroll is, and the more often you have claims that exceed the $1 million, the more you'll pay in that shared pool layer.
Mark, one question about that. How is it determined where the shared losses end and the commercial insurance begins?
When the total loss exceeds $5 million is where the commercial insurance begins.
Right, but how was that number selected in the first place?
I'll be getting into that in a little while.
Okay, great.
The short answer is that was what the membership in the pool decided to buy insurance at. But you'll see that in a little
Okay.
on the slide coming up.
Mr. White.
Thank you, Mr. Chair. And how is the dollar figure arrived at for this pool? In other words, you have the up to $4 million, you have that extra $4 million, and it's based on employment and a loss record. Then is it just like a lockstep plug into a...
It's a mathematical, Mr. White, it's a mathematical calculation at that point based on all 12 members. If there is a loss for $2 million, meaning $1 million goes into the pool, then everybody pays their pro rata share based on those 2 items, their payroll and their experience level. And there's a mathematical calculation that is done by our program administrator. So right now, Santa Barbara is contributing about 8% to losses in that pool layer based on our payroll and claims experience compared to the other 11 members.
And how long does that have a lengthy history, that pool? And
Excellent question. The city is a founding member of Excel. The pool was founded in 1986, August of 1986, and we've been a member ever since.
25 years kind
Yes.
of thing?
Yes.
Okay. Thank you.
Moving along, this chart shows our claim frequency in the liability program over the last 10 years. Overall, the trend is downward, not as significant as the workers' comp program, but it is still a downward trend in the number of claims filed. And following along the same logic, fewer claims will equate to fewer dollars paid. And when you look at the amount paid each fiscal year, each
Mr. White, you have a question?
Well, just if you could characterize those claims a bit, that would be helpful. What are is there like the top 3 batches of liability? What would that be?
Mr. White, it varies year to year, but historically, the largest number of claims that we see are for trip and fall claims from sidewalks and the like, auto claims, auto liability claims where a city vehicle has struck another vehicle or other property, and to a lesser extent, those claims involving police forces. Those are the more frequent ones. But the biggest one is the trip and fall claims on the sidewalk. So moving on to claim severity, this is the amount of money that we showed on the books for each of the claims filed, what we call our incurred amounts, the amounts paid and reserved for future payments over the last 10 years. And you can see that these numbers have shown a downward trend over the 10 years as well. These numbers are all as of June 30th, fiscal year 12. And then these are the actual payments that the program made in each fiscal year for liability claims in each year. Overall, the amount paid has hovered in the $200,000 to $400,000 range. You will see that there are a couple of years where it was slightly higher.
If I could, can you go back to the previous slide, Mark? Just to make sure we understand, so these numbers here are what our actuaries tell us, or our claims administrators tell us that we should be adding to the amount of money we have in order to fully satisfy these claims. So, for example, in 2012, they said, based on the claims incurred in 2012, we should expect to pay over the life of those claims, typically over the next 5 years, $285,000. The next slide, which is really on for all claims that are outstanding, what's the cash flow? How much are we paying out the door? And this doesn't mean we're fully satisfying these claims. This is just money out the door for all claims outstanding in any given year.
Okay, thank you.
And then moving on to the excess liability premiums, you'll see that those have been creeping upwards over the 10-year period of time. This following the fact that we've had higher claims payments in recent years and the hardening of the insurance market in this area, which we'll be talking about shortly. Here is a chart showing the historical coverage limits that XL has had over the 25-year period of time. And you'll see that when the pool was initially created, every city retained the first $1 million in losses, and then the pool shared losses up to $10 million. Over the years, where the insurance market has softened, we've been able to back off of the shared amount in the pool and purchase commercial insurance and move it back and forth depending on which is more cost effective for the group. When it's more cost effective to pool our losses, the pool does so. When it's more cost effective to buy commercial insurance, it does. And of late, it's been more cost effective for us to buy commercial insurance than to pool those losses. And currently, it has been enough that we were able to drop the pool layer down to $4 million and add coverage limits above that to now $50 million in coverage. There are 3 members of the XL pool who purchase limits in excess of the $50 million that we do. They are much larger organizations with much greater exposures than we have.
And if I could add, from 2007 to 2013, you can see we did raise the coverage limits, and we made a conscious decision to say, for the same amount of dollars, we could buy additional insurance or get additional coverage rather than sort of lowering our costs overall to the city. We'll say, let's keep the same dollar amounts, but we can buy more with that. So that was a way to sort of use those same dollars to get better coverage.
So the issues and considerations moving forward for the liability program are that the excess and primary insurance markets remain unstable in the markets from $1 million and upwards. Early indications from industry analysts are suggesting double-digit increases for 14 and 15. And that can make us all take a closer look at how we, as a member of Excel, share those pool losses. Do we move that from the $4 million back to the $9 million in shared losses and only buy insurance above $10 million? Those will be the discussions that we'll be having at the next 2 meetings of that pool.
How many members in Excel?
There are 12.
Okay.
We're one of 12.
Okay.
And moving on to the property insurance piece. The city owns a variety of property, buildings, facilities, the building we are meeting in today. And the city purchases, quote, all-risk property insurance that covers damage to the more than 380 buildings that it owns. The all-risk term is a misnomer. I say that because the policy excludes several common things that the city covers elsewhere, and we'll talk about that shortly. And as Mr. Samario mentioned earlier, the city does not purchase insurance to cover infrastructure, streets, sidewalks, conduits, pipes, bridges. It's just fiscally impossible to do that. It wouldn't be prudent use of the public funds. It's available at a very pricey number. So as we go through, first be talking about this, quote, all risk, and then we'll talk about the things that are excluded, which are specifically things that fall under what we call a difference in conditions. Most people refer to it as earthquake and flood, and boiler and machinery, those things that have a pressurized vessel. Those aren't covered in the general all risk. So the all risk covers fire, wind. We have added a boiler and machinery piece to that. It's a separate policy that's now in it. And we provide excess terrorism. After the 9/11 actions, the federal government required all insurance carriers to provide the option for a terrorism coverage, because one of the common exclusions to every property insurance policy is loss or damage from an act of war. So the city now has the ability to have that terrorism coverage added on, and in years where it is nominal, we will employ that, and where years where it is no longer nominal, we will drop it. The total insured values for all the 380 buildings owned by the city, $464 million. It insures up to the replacement cost for damages to those buildings, with a deductible of $50,000, except for Stearns Wharf, that has a deductible of $250,000, with coverage limits of $1 billion. What the city does is it purchases its property insurance through a program called PEPIT. It is a consortium of cities, counties, and states that purchases coverages for most of the western states and several midwestern states, and they're able to get competitive and very nice terms for us at a reasonable cost. The coverage limits of $1 billion far exceed what the value of our buildings are today. Now we move on to the difference in condition, or what most people call earthquake or flood. We have total insured values of about $455 million. You notice the difference in values from this slide, from the last slide. And this slide has a deduction for our fleet that's part of the previous slide. The deductible is 10%, subject to $100,000 per facility or building. That is changed this year from last year. The quote that came in for fiscal year 13 was beyond what we had budgeted for this coverage, and we had to make the difficult choice of raising our deductible. We raised it to a 10%, up from a 5%, and from a $50,000 minimum to a $100,000 minimum. Coverage limits are only $50 million. So if we have a large-scale disaster, we will have $50 million in limits only. When you look at that, that's approximately 11% of our total insured values. Increasing the coverage limits from $50 million to a number closer approaching what our total insured values are would increase the cost of the operating department substantially. That's a decision that has to be made whether we want to continue at just the $50 million limit or not, but that would be a substantial price increase.
Mr. White?
Thank you, Mr. Chair. And are there higher deductibilities than the 10%, 100,000?
Mr.
I
White,
mean, you're obviously looking at that as you've done that already as your balancing act.
and we will continue to do that. There are higher limits available, and that's some of the things we have to look at.
Yeah, great. Talk a little bit more about that. I mean, that's a big uncovered risk there, and it's a very real one here. So
It's a very real one here, and we can raise deductibles to a much higher level. One of the things that falls out at that point is damage to buildings that have a total value of less than the deductible amount.
right.
One of the things that we would look at here is in the event of a large-scale disaster, and we can receive money back from the insurance company rather quickly, several months at the most, or until once we have a documented loss, then it would be up to the executive management to decide which buildings we use that money to repair and or replace. We obviously would look at essential facilities first, and non-essential facilities may or may not receive any repairs early on. So that's kind of the balancing act we look at. Could we raise that? Yes, but then do we
At what
eliminate
cost?
half of our buildings because they're now the deductible is greater than the value of the building?
Or split it. I mean, could there be obviously there's a lot of options there, but that's a big uncovered. It's obviously a huge uncovered liability.
It's a big uncovered liability, and we continue to look at that and try to decide what is a reasonable value for purchasing this type of coverage. And is it better to pay a little bit more in premium? Is it better to change our deductible levels, which we've done many times over the years?
And keep in mind that we would also be eligible if it was a significant earthquake where we had that kind of damage. It would likely be declared a federal emergency, a state emergency. So we would be eligible for state and federal monies to reimburse some of our costs. So we have a combination of insurance, federal and state reimbursement dollars, and we do have some reserves. That's the whole point of having reserves in our operating funds to help with that. So we're not, it's to think we're 10% covered is really not, I think, true. We have the ability to get reimbursements from the federal and state government that would help offset those losses.
So the disaster declaration ends up. Does the city get grants in that situation?
No, we would get, depending on what's determined by the state, but a combination of the federal and state government, we would typically get somewhere around 90% of all of our costs reimbursed that are considered eligible. So there'd be a pretty high level of recovery above what we would get from our insurance company.
Okay. Thank you, Mr. Chair.
Sure.
So the issues and considerations going forward with property and the earthquake rates may increase by 10% or more in the coming 2 fiscal years. Actual replacement cost values compared to the stated values. We have the PEPIT program automatically appraises buildings that we have identified with a value of $5 million or more every 3 years. They will be coming around in calendar year 2013 to start that process again. There are 4 buildings there, and changing those values are going to mean that the price of property insurance is going to increase because the value is increased. What we insure and what we don't insure, that's the discussion that Mr. White was suggesting that we have, and the types of coverage that we continue to carry. Do we continue to carry?
Oh, well.
Oops. We got this one. So, whether we continue to carry earthquake or flood is also part of the discussion. And we'll continue to have those discussions internally and seek your guidance where we feel it's appropriate.
Something's burning.
Turn it off. Oh.
I think we should call 911.
I do.
This is the bulb that popped.
Oh, yeah,
Yeah.
that's probably it.
Right.
Okay, so moving to the next screen, the other issues for earthquake are, as Mr. Samario was pointing out, response by FEMA and CalEMA will come later. It's on a reimbursement basis. Those funds will likely show up 5 or more years after the event happens, and we need to get from day of event to that point. And as he mentioned, we do have insurance monies to rely on as well as reserves, and how we get from point A to the reimbursement by those other agencies will be a juggling act. And as I said before, when we get the insurance monies, it'll be up to the executive management to decide which facilities are critical and get immediate repair and or replacement, and which are non-essential and are postponed until better dates. And with that, I bring the end of my presentation. Any
Thank
more
you, Mr.
questions?
Howard. Questions from the committee members? Ms. Murillo.
Thank you, Mr. Chair. Thank you, Mr. Howard, for your information today. So we're a medium-sized city, I think, in the bigger picture of California or the nation, I'm not sure. But so does a city like Goleta have the same kind of insurance, or we're bigger, wealthier maybe than Goleta? No offense, Goleta.
I'm sure Goleta's not taking offense. We, in the insurance industry, categorize cities as large, small, and medium. Santa Barbara is definitely a medium-sized city in that scheme of things. A city that is in the medium range would have similar insurance and similar coverages. A smaller city, I'm not certain if Goleta fits in the smaller city category or not, probably it does, would have less self-insured portion of their portfolio than a medium or larger size city, because they can't afford that kind of a risk. It's a risk analysis thing that we in the insurance or risk management function and the finance director do the arm wrestle on. Where can we afford to take this type of exposure, and where can we not afford to take that kind of exposure? So the program is about the same. It's where the self-insured retentions fall for most.
Thank you.
Mr. White?
Thank you, Mr. Chair. I am sure that you have looked at that you look at the package that the city infrastructure and at what's critical and what's not critical, and establish value relative to those categories. Do you have a sense of that? I don't know, what do we have in the way of critical? I mean, I'm thinking, like the water treatment plant, sewage treatment plant, city hall, et cetera. Have those been split out? And as I say, I expect you have, but can you talk about that a little bit?
Mr. White, yes, we have had that kind of a discussion both internally and with Yoli McGlinchey, our OES coordinator. And the critical facilities, you identified many of them: water treatment, wastewater treatment, the public safety buildings, fire stations, police stations, to a lesser extent, City Hall and the libraries. After that, then it becomes more something for the other executives to do the arm wrestle about, is why their particular facility might fall into a critical category. But to me, the critical categories start and end with water and wastewater treatment.
Okay, and obviously the $50 million probably wouldn't cover those, would they?
If we
No,
were
they would
to,
not.
the short answer is no.
Yeah.
If there were a devastating natural disaster that completely wiped out either the water treatment or the wastewater treatment plant, the $50 million worth of coverage would not replace either one of those plants.
Okay. And I guess, Mr. Chair, then obviously we're here because this is what staff thinks as a prudent package going forward.
Yes.
Okay. Thank you.
Okay. Mr. Howard, Mr. Samario, thank you very much. Meeting adjourned.